Welcome to Breaking News to Trading Moves. Today we're looking at an event that's a powerful reminder of, well, just how much global finance depends on physical things. Specifically, on something as basic as data center cooling.
It's a perfect case study, really. You have this localized technical problem that ends up having global consequences. The event is centered on the CME Group. They run the world's largest marketplace for futures and options.
And they had to halt trading for several hours.
That's right. And it all stemmed from a technical failure, a cooling problem at one of their data center facilities.
And this wasn't even their own facility, right? It was a third-party operator, CyrusOne, out in the Chicago area.
Exactly. And the halt was, it was total. Trading just froze across these incredibly important contracts.
We're talking currencies, commodities, U.S. Treasuries, and futures on all the major stock indices.
When the AC goes out, the entire market just stops.
What really adds another layer to this is the timing.
It does. It happened on that quiet Friday after Thanksgiving, which you might think is, not a big deal.
But it was month end.
It was month end. And for big institutional investors, that's a critical period. They have mandates to rebalance their portfolios, and they often use these exact futures contracts to do it.
So we have these massive funds that are legally obligated to make adjustments, and suddenly they have zero liquidity for hours. That's a lot of stress in the system.
Oh, for sure. And you can bet the regulators noticed. Both the CFTC and the SEC are monitoring this very closely.
It seems to confirm that operational resilience, the ability to stay up and running, is now a top concern for them.
It's become a systemic issue, and this event, it's like a real-world stress test. It lets us see which companies were prepared for this kind of failure and which ones weren't.
So let's break that down. Let's start with those who are positioned to benefit, the companies that basically sell a solution to this exact problem.
Okay, let's do it.
First up has to be the most direct one: infrastructure and data center resilience.
Absolutely. The whole mess was triggered by a cooling failure, which just screams vulnerability if you're relying on a single site.
It really puts a spotlight on that.
It does. The financial industry has been moving towards using these specialized data services for a while, but this shows that not all providers are created equal.
Right.
Relying on one provider or a setup without immediate, comprehensive failover is now seen as a major operational risk. This just accelerates the need for better redundancy and more sophisticated hybrid cloud solutions.
Which puts the companies that provide that high-end infrastructure in a great position. We're talking about firms like Equinix, ticker EQIX.
And Digital Realty, that's ticker DLR.
And of course, the giant in the space, Amazon, with AMZN.
The thinking here is pretty straightforward. An event like this just reinforces the long-term demand for what these guys do. They specialize in multi-region architecture and superior failover capabilities.
So if you're a bank running critical software, you're now thinking you need more than just a backup generator.
You need a whole separate, cooled, connected building miles away, managed by someone whose only job is to perfect cooling and connectivity.
But isn't that incredibly expensive? Building out that kind of redundancy, contracting with an Equinix for a whole second facility. How does an exchange justify that cost?
That's the calculation that just changed. The cost of an outage is now clearly higher than the cost of redundancy.
I see.
When you factor in the reputational damage, the regulatory heat, and the lost revenue from stopping trade on massive contracts, that investment in resilience from a Digital Realty starts to look less like an IT expense and more like an insurance policy.
A mission-critical one.
A mission-critical one that the market is now willing to pay a premium for.
Okay, that makes sense. But let's move beyond the physical hardware. The cooling failure stopped trading at a central exchange. How does that help other companies in the trading world?
It exposes the weakness of putting all your eggs in one basket, liquidity-wise. When the CME goes dark, everyone is instantly reminded of the benefits of having different places to trade.
So it strengthens the case for platforms that operate outside that traditional centralized model.
Precisely. You're looking at electronic trading and over-the-counter, or OTC, platforms.
Like TradeWeb, ticker TW, and MarketAxess, which is MKTX.
Yes. This kind of event could drive more trading volume and tech budgets their way because they already offer deep, diversified liquidity, especially in rates and credit. They let clients hedge risk using different methods, like request-for-quote systems, that are completely independent of the CME's order book.
So it's like having multiple rivers to draw from instead of just one big reservoir. If one dries up, you're not stuck.
That's a great way to put it. It's structural diversification for liquidity.
All right, what about the third group of winners? You mentioned multi-asset brokers. How do they come out ahead here?
This is where operational excellence really starts to pay off. We're talking about brokers that have invested a ton in their own internal systems.
Companies like Interactive Brokers, ticker IBKR.
And Charles Schwab, ticker SCHW.
So how does a problem at the CME translate into a business advantage for a broker?
It comes down to two things: routing and trust. The brokers that can send orders to many different venues who aren't reliant on a single input can show their value.
Okay.
But maybe more importantly, it's about communication. The firms that were clear and transparent with clients during those hours of downtime.
The ones who are actually explaining what was going on.
Exactly. They are now perfectly positioned. In a crisis, that communication becomes a product feature. It's a huge competitive differentiator.
So traders and funds are now going to be looking for brokers who proved they could handle the chaos.
Without a doubt. They'll gravitate toward the ones who could say, the exchange is down, but we're still here, and we're actively helping you manage your positions. That builds a lot of trust.
That paints a pretty clear picture of who stands to gain. Now let's flip it and look at the groups that are under pressure. We have to start with the exchange operators themselves.
Absolutely. They are right in the middle of it.
The main one is CME Group, of course, ticker CME. But this puts pressure on the whole sector, right? Cboe Global Markets, ticker CBOE, and NASDAQ, NDAQ.
Yes, even though the failure was at that third-party facility, this was one of CME's longest outages in memory. And that prompts some very tough questions about resilience standards across the entire industry.
When you can't trade U.S. Treasury futures for hours, the regulators are definitely going to demand higher standards from everyone.
They have to. And that translates directly into financial headwinds for these companies.
Higher costs.
Much higher costs. Implementing that extreme level of redundancy we were just talking about, the multi-region, geographically separate backups, that requires a lot of capital.
So their margins could get squeezed.
It'll pressure their near-term margins and, you could argue, their valuations. This is a cost center that just got a lot more attention.
Okay, so what about the second group that felt the immediate impact? The high-frequency and market-making firms.
Ah, yes. Their entire business model is built on continuous high-speed operation.
We're talking about firms like Virtue Financial, ticker VIRT.
And BGC Group, ticker BGCC.
So for them, what does a multi-hour stop actually mean?
It's more than just a drop in volume. It paralyzes their automated model-based systems. I mean, think about it. Their algorithms are designed to react to price changes in nanoseconds.
And suddenly the price is just zero or non-existent.
Exactly. Liquidity is zero for hours. The entire model is facing a scenario it was probably never programmed for.
So what does that chaos look like for a firm like Virtue operationally?
It's like a self-driving car suddenly losing its GPS and all its sensors while it's going 100 miles an hour. The algorithm is screaming, I need to execute this trade to hedge that position, but the market data just says nope.
No price, no trade.
Right. So you end up with all this noise in their P&L statements because they have these inventory positions they can't adjust or hedge in real time. They're just sitting there with unmanaged risk for the entire outage.
Which for a business built on managing risk at lightning speed is a critical failure.
It is, and it leads to all these unforeseen costs later, recalibrating the models once the market finally reopens.
Okay, and finally, let's touch on the futures-heavy brokers and clearing firms.
Yeah.
They didn't cause the problem, but they're downstream from it.
That's right. They're highly dependent on the CME's products running smoothly. So we're looking at platforms like Robinhood Markets, ticker HOOD.
And also institutional players like StoneX Group, ticker SNEX.
Correct.
What's the immediate financial impact for them when their main hub just goes dark for a morning?
Well, first, there's the direct loss in commissions. If a big chunk of your volume comes from CME products, those revenues just evaporate during the halt.
And I imagine it's not great for client relationships either.
It can be very damaging. Even though it wasn't their fault, the client's experience is that they couldn't trade on their broker's platform. The pain is felt all the way down the line.
And they probably have to spend money now, too.
Precisely. They'll likely incur new tech and communication expenses because they now have to upgrade their own contingency plans and how they talk to clients in a crisis. Everyone who relies on the CME has to react.
This really shows just how interconnected the market infrastructure is. One cooling unit fails in a building in Chicago, and the effects are felt across the entire system.
I think the main lesson here is that operational reliability just jumped to the very top of the priority list for the entire market. It's undeniable now.
The companies that were already prepared, that had invested in that robust redundancy, They're the ones who benefit.
They are, or the ones who provide those services. It really shows the fragility of a centralized, single-point system.
It definitely puts the spotlight on infrastructure and crisis management. And,
Yeah.
building on what you said about those high-frequency firms like Virtu and BGC, it brings up a fascinating question.
Oh,
Well, we talked about the operational difficulty, but think about the architectural challenge. I mean, how do you even design these incredibly complex automated systems to correctly account for zero liquidity? For a market that's just frozen for hours, it goes beyond just technology. It questions the very assumptions those algorithms are built on.
that is a very good question. A test case for resilience engineers for years to come, I'd imagine.
As always, we need to close with a necessary statement. This discussion is not financial advice, nor is it a recommendation to buy or sell any security mentioned. This analysis is purely the opinion of the author of the material we reviewed.
Thank you for joining us for this analysis of breaking news to trading moves.